Hello there, this is L.A. Little. This is the Neoclassical TA Crash Course. It's a course, 3-day course that we're doing to teach the Neoclassical methods. Unfortunately, when recording, we were doing Skype sessions with the 10 members that were interactive, and unfortunately the first part of the video was lost. It was corrupted, so I'm having to re-record the first part of the video. I'll do my best to emphasize those same things that I did in the video, but it will be probably somewhat different. The same concepts will be covered though. Initially I talked about Skype mechanics. It's not necessary to go over that here. The agenda was to do our best to work through the model completely, starting with the basics, a few more advanced topics as we go on. In this particular series, on Saturday we're going to end up and dive deeper into the model and its application, and then next week we're going to actually take that application of that model and apply it to the market live and show you how to use it on an intraday basis. The model works on any time frame, whether it's intraday, whether it's daily charts, whether it's weekly charts. It doesn't matter. Concepts are all the same. The application of them is the same no matter what time frame you're looking at. There were some more mechanics here about the actual session that we were holding. It's not necessary for me to go over some material and homework. I want you to review the homework, not the homework, but review the videos and come back with questions. And some general thoughts that I had was that trading's simple. You either win or you lose. You make money or you lose money. And if you're going to make money, you're going to have winners and losers. You're not going to have just winners. If you do have just winners, you're taking huge drawdowns probably to get them. And that's not really the way you should be trading. So to make money, consistently, you need to be able to read the tape. And Neoclassical really is the old tape reading back from the early 1900s, where we're focused on supply and demand on the charts. Supply and demand is what moves everything. The charts actually, if you can tell what's significant, the charts will give you tests. They give you information about what those areas are telling you. So in other words, when you come to some area that's significant and it tests it in the sense that price goes up against whatever the price was there, then you can look at how it attacks that area, decide from that what it actually tells you, and then use that information to make decisions that give you a better chance of being on the right side of the trade. In order to trade and make money, you gotta have good money management. It's not just about being able to read the charts. You gotta have a way of getting in and getting out and managing the trade while in it. And generally, you want to keep the odds in your favor. So in other words, there are specific patterns, if you want to call them patterns, or specific setups that take place. When those setups occur, there's associated probabilities in the model. And you want to take those probabilities and you want to trade the highest probabilities most of the time. And so you want to consistently do that, keep the odds in your favor, because in the end, it's a game of probabilities. You're never going to have all winners unless you're willing to take those large drawdowns. That's really not what it's about. TA, Neoclassical TA at least, is about timing and direction. It's trading with the odds. The money management assumes that you're able to read that tape and then minimize your drawdowns and never take huge losses, so that you're always near your highs. If you're within 2 or 3% of your highs, you're doing the right thing. If your drawdown is 8-9% off your highs, then something's wrong. You need to analyze what you're doing wrong and consider what that is. So I'm going to move on here. Let me save this. Actually, let me just move this off the screen. I'm going to move on here to the actual presentation. So as I go through this, members had a chance to ask questions at various intervals. On the second tape, you'll see that questions being asked, intervals being taken to take questions and answer them. Learned a little bit on the first taping here. Hopefully we'll get the rest of the tapings a little bit better. This taping is actually going to be a little better quality because I don't have to tape the whole screen. With Skype, it ends up that I need to tape the whole screen, it appears, in order to get a good taping. So we'll see if we can improve that, but if not, then you'll see that on the rest of the tapes. Trade successfully. You got to understand the principles, right? So like anything else, if you're going to do something well, you're going to have to learn what the principles are and practice those things. And so you got to understand what the principles are. You got to be able to understand what the odds are for those various setups that take place. You got to understand what's moving the market on the varying time frames. And what I mean by moving the market, I'm talking about, which instrument is moving the market, not which set of news. So, is it currencies? Is it this particular stock or index, or some overseas index? Whatever it is, you need to understand what's moving the market at that time. You need to be able to try to pick that out as best you can, and then key on that and watch that for the tells, because that's the most important thing at the time. You need to find the higher probability trades, investments on a given time frame. There's some tools that are built that allow you to do that, but in general, that's what you're trying to do. And you really should have a set routine each day for what you're going to do, whether it's the research part of it, whether it's the actual trading of it, whether you're trading all day or part of a day, whether you're really just trading every now and then. You just have to have a routine, because preparation is half the battle. Actually, it's most of the battle. And if you're not prepared, you're not going to be able to make good decisions when it's time. So in general, you got to have full confidence, and that only comes with practice and time. So what I'm going to do is give you a crash course through this model and show you how it works. Okay, so let's get into the model. Now, the first thing I did when I was doing this video live was I popped in here, brought up the watch list, and I was telling them that I was telling the members that there's a useful thing that you want to do is just create a watch list or go to a shared one or whatever. Come down here, hit the show all charts, which will pop up this little icon, and let me grab it for you and bring it on the screen here so you can see it. It's a watch list control. And the watch list control, if you take your stocks, your charts, there's 3 charts in the trading cube. If you put them on the screen wherever you want them, let's say I put them here and I take the trading cube and put it there, and if I bring that watch list control back up and I hit the save the current window locations, anytime I come in here and click on this to get my stocks, it will bring those charts back up in exactly the place that you laid them. And so that's one useful thing you want to do. Set your screen up the way you want it, save that the way it is, and then that way anytime you're looking at the charts, it will bring them up in a fashion that allows you to see them all at the same time. And it's important to see them all at the same time because you need to be able to look at all the time frames. So the neoclassical principles, they're really centered around 2 things. It's trend and it's timing. And on the trend side of it, what you're doing is you're trying to find direction. Direction meaning that the old definition of trend prior to the neoclassical one was a series of higher highs and lows is an uptrend, series of lower lows and lower highs is a downtrend. And so what I did is I said, well, that's well and good, but that's not very precise. Let's make a precise definition. And so through studying the markets and through studying the charts, what I discovered is that let me grab a chart here. What I discovered is that there's a algorithm that you can create that will give you what that is. Now, the TA Today charts actually keep track of all preceding bars that have taken place all the way back to about 2007 in most cases, some of them earlier. And it's got all that in the database, and so all these charts already have all those markings. What is important is to be able to define what is a swing point high, which is an H on your chart, and a swing point low, which is an L on your chart. And the way you define that is you come onto the screen and you look for the first low that you see starting at the left hand side, the first low and the first high, or you could just start with the first bar. And you look at it and you say, okay, that high is whatever the price point is, and you can get the price point by just hovering over it. You get the price points up here at the top. If the next bar is a higher high, so the very first bar is a potential high and a potential low, and because of the TA charts the way they are, like this one got marked as a swing point low, that's because there were some other bars over here that you can't see. So for purposes of this demonstration, I'm going to start somewhere else. I'll just start here on this bar, and we're going to define a high first. So I have a high here, and if I look at the next bar, is it a higher high? If it's not, then that's 1 bar, and since the potential high. If I go to the next bar and it doesn't have a higher high than that potential high, I keep going. If I go 6 bars, 1, 2, 3, 4, 5, 6. If I go 6 bars and don't get a higher high, then that potential high becomes an actual high. It gets an H on the chart saying it's an actual high, and this bar now becomes the potential high going forward. And so if we go to the next bar, is it a higher high or not? It is, so it becomes the potential high. And you keep doing that until you don't get a higher high. And so we get up to here, and now we get 6 lower bars. That one is a actualized high, and so forth. Same thing on the lows. So you start at a low, let's just say we started with this bar. Lower low, no it's not, that's 1 bar. Lower low, yes it is. We reset. This is the potential low now. And you keep doing that. Eventually you find this is the low. You go 6 bars without a lower low. And so you're always going to see at best 6 bars in between a series of lows or highs. Can't happen any other way given the algorithm. Now this is true no matter what time frame you look at, and any chart you look at is going to have 60 bars. Everything is standardized to 60 bars because there's, if you have more than 60 bars, as we go through this, you'll find out you have way too much information. And so we standardize on 60 bars, and we standardize across all time frames. Daily, weekly, monthly charts is what the TA Today charts have. But these principles apply whether it's daily, weekly, monthly, if it's intraday, 5-minute, 10-minute, 5-minute, 15-minute, 30-minute, whatever. It's the same. And on the top side, if you were doing quarterly charts, they would be the same too. Standardize on 60 bars. Standardize on how you create swing point highs and lows. So to get a trend, that's these arrows that you see. To get a trend, you have to break a swing point high or break a swing point low. So in this case, if we're looking at this particular chart and we pull it up and we just pull up a line so we can see where that high was, when it gets over that high, and it has to close over it, when it gets over it, closes over it, it changes trend or reaffirms trend depending on what the trend was previously. Now because this one is a up arrow and it's green, it's telling you the volume here was greater than the volume on, well actually it's this bar, the volume on the prior swing point high. So you had higher volume when you broke. That's a confirmed breakout. Now what does it mean by confirmed? Well, it means that it has a higher probability of continuing. Now you can have suspect, and in this particular chart we don't have any, and they would be red. And we'll bring up a chart that does have some red ones, and I'll bring over the weekly chart. And here you can see red bars. Red means that the volume was less than the bar that it broke. And in this case it broke this bar. Volume there was 185 million, and it breaks it with 165. So you have less volume, you get under it. Now a lot of folks will tell you, oh, less volume, therefore it's not going to continue. Well, that may be true, but just like you see on this particular chart, it did continue. What it really means is that it has a lower probability of continuance. And it was at this point that I came over and said, you can see what those things are if you go look at these charts. And I said to the members, go to the trading cube under your tools, and if you pull up the trading cube and you pull up that same stock, and in this case it's the IWM, if we pull it up and put it on the chart, it will have the trading cube for it, and what you're going to see is basically like an accountant's balance sheet of a company. It tells you what that company is doing at that point in time. That's what this does. It gives you a snapshot view of the trend across 3 time frames, across 3 instruments, and qualifies that trend in terms of the trend itself, what it is, whether it's suspect or confirmed, which is green and red. But it also gives you something called the mean time to failure, which are these percentage numbers that you see under it. So when you get a break, a percentage break, or when you get a break on this cube, and this is going to get reset to some small number. So in other words, when you transition trend, the mean time to failure, which is what this number is, and that's a cumulative mean time to failure, resets. And so if I pull that chart back over here, so let me grab the chart while I'm doing this, and we look at the last time this went bullish. That would be right here. Let me pull this over so you can see it. It would be right here when it actually went bullish there, and then it broke another swing point that's somewhere off your chart. It breaks that one, the volume was less, and so you get a suspect trend. Now, what's the probability of this continuing? If you come here and you click on this, it will pop up a little, grab it for you if I can and bring it over. Bear with me a second. Here we go. It will pop up this projections, mean time to failure projections, and you can think of it like a light bulb. You know, a light bulb comes off the assembly floor. It's going to last roughly 2,000 hours. If it's at 25% of its life cycle, or in this case 25.4%. I was looking at the wrong one. It's really 28.1 on the IWM. So short term, 28.1 IWM. If it's on its life cycle, 28%, well, if you had 2,000 hours life cycle, then this is roughly 280 of those life cycle, or I guess 28% would be more, it'd be 560 of those. If you look here, you have the same thing. Instead of how many hours, you have how many bars. How many bars is this expected? And if you scroll down, you can see if it were to go to 100%, it'd be 100 bars. You know, it'd be almost 100%, and actually this never goes to 100% because it can continue forever, right? Indefinitely, potentially. The practicality is that it usually goes to about 70 to 80 at most. That's where it's kind of a nosebleed. So 70% to 80% in this case is 50 bars versus 39 bars. So somewhere between 39 and 50 bars, this thing is going to get to kind of a nosebleed situation, and it's going to try and transition trend again. Because it's bullish, the only way it can transition trend is to change to something else, which you know, if you think about it, you only have bearish, sideways, and bullish. And so if this is going to transition trend, it's going to have to break a swing point low. In this case, the swing point low is right there. So if it were to break under that, trend would change to sideways, and you'd see a sideways arrow, red or green, depending on how much volume was on the break. So when you think about all of that, that's how you get trend. That's how you can determine whether the trend is up or the trend is down or the trend is basically sideways. Now, if you were doing classical, you might call this a downtrend, but it never really broke a swing point low or two swing point lows after it was a high, right? After it was a bullish. It only broke one of them. That's this green one. It never broke here. So really, if you talk about this classically, you probably would have labeled this, let me grab it here, you probably would have labeled this as an uptrend, you probably would have labeled this as a downtrend, and then another uptrend. Well, neoclassically, that's not how you would have labeled it. What you really would have labeled it is you have an uptrend, right? You have a sideways trend, and you have a continuance uptrend. And so it's a very different picture than what you have classically. And that's because you have precise definitions that you can work with. Now, like anything, they're not always going to work. They're not always going to give you the best reads, but they give you pretty good reads, and they tell you what the trend is. So again, getting back to one of the basic principles, you want to try to trade with the trend, not against it in most cases, because the trend will typically bail you out. If you're wrong, you've got the rest of the market working for you. And one of the things I brought up and will bring up again here is if you go over to market trends and you bring the market trends up, what you're going to see, the way to think about trend and think about the relationship between stocks and sectors and markets is that there's really two principles at work all the time. One is that when you're looking at, in this case I will do time first, when you're looking at the short-term trend affects the intermediate-term trend. The intermediate term trend affects the long-term trend. You really can't change trend here unless you change trend there. Usually this one happens before that one. Same thing here. You can't change intermediate unless you change the short-term trend. So if I'm bullish, or in this case bearish here, I can't go bullish here without going bullish first in the short term. It's just not possible. And so thinking about trend and considering time, short term affects intermediate, affects long. That's why you look at all three time frames all the time. The other thing that's at work is what's moving what. Now, although not shown here, you have stocks at the bottom. Stocks make up sectors. Sectors make up markets. And so what you have is a set of sectors that are going to affect the market, and the stocks within the sectors are going to affect the sector. And so if you're wondering where financials are going to go, you just drill down into this and look at the individual charts inside of it and the weighting structure of it to tell where it probably is going to go given a neoclassical read of those stocks. You can also, of course, look at the ETF itself, but in general, the stocks move the sector moves the market. Conversely, if the market is getting weak and you have a strong stock, that stock's probably going to have problems just because it's within the stock market, right? So this, and in the third book you'll see references to this and the numbers associated with it in terms of probabilities, but general market will affect individual stocks. Sectors will affect individual stocks. What does it affect? It affects the longevity of whatever trend is in place on that stock. So if I bring that chart back up and I'm saying that this trend is bullish, or actually if I go let me bring that little MTTF back up, and we're looking at it from, keep this on your screen, we're looking at it from this time frame. It went bullish here. What's the probability of continuance? Well, it has a decent probability in about 70%, so 39 bars. If it were confirmed, it would have a higher probability. If the market is bearish, this is going to have a more difficult time getting into the higher numbers because the general market is going to be pulling against it. If the general market's strong, then it's going to help it. Same thing with the sector. It's going to help it. How much? It depends on what the sector is. It depends on what the general market is, and those numbers are outlined in the various books. If you consider the fact that trend is your friend, you always hear that, this is why it's your friend, right? Because these things move each other. So going back to where we were, the ideal is that timing, trend and timing are what make up the neoclassical market. We just talked about how to figure out what trend is, how to figure out where your swing points are, and how trend transitions. Trend always transitions, one break at a time. So one other thought here while we're on this subject, and I'll see if I can find a case of it. Well, I know we have a case on the S&P 500, so let's just pull the S&P 500 up. And I've got the S&P 500 up on a weekly chart now. What you have when you break trend, and in this case there was a test failure to break trend, and we'll talk about that next. But here was the test trying to get over this swing point high, and there was a swing point high over here as well. As you break, let's say it broke out, and let's say it closed above it, the way you figure what that arrow looks like, right, what the current trend is in terms of whether it's suspect or it's confirmed, is you first transition through the lowest of the highs, and you assign that first, and then you go to the next highest high, and so forth. So if there's 2 or 3 of these, you would simply go from, in this case, you would go from sideways to bullish, to reaffirm bullish, to reaffirm bullish again, and you do it all in one bar. And that's possible. Sometimes that happens, especially on wide price spread bars, which we'll get to in a bit. So that's how you assign trend. If you look at this chart, how do you know what the trend really is? Well, again, you can go back, in other words, what did it break? You can go back to the trading cube, because one of the other things in the trading cube here is that you have down in these two areas here, you have a table of those trend transitions. So the transition, the qualified trend, what it is, and they're listed, you know, in order of the transition date. You can actually flip these orders. Just click the columns. You can flip any of the columns. But it transitions to sideways on this date. Closing price was that. This is how it did it, right? And it's on this time frame. And so if you wanted to know exactly what got broke and you can't tell from charts, you can come over here and get it. And it does it 3 deep. When we get to support and resistance zones, you have the same thing here in this table. It will show you what the top and bottom of that support or resistance zone is, the dates of them, in other words, what bars are being used, and a ranking. And it will tell you the time frame. So if I were to look at this and just use this one down here, I can see that the last thing here is the ranking. I can see that this on the short-term time frame, this has the highest ranking, the resistance. On the short-term time frame here, I don't have, they're all equal. So there's none of them stronger than the others. Now this is a proprietary ranking. I'll get into it a little bit as we get into that material. But again, all this data is on the Trading Cube page, and you can use that to your advantage. Let's see, going back to this, that's trend. So I think we've pretty much covered what trend is, how it is formed, how you define it, how you transition and change it. And I think that's it. So now, what's the other big piece? Timing. Timing is critical for entry and exit. So if you think about trading, right, there's two things that are important, which of course are the two basic principles of the model. One is, which way are you going, right? What direction are you pointing? The second is, where do I get into this as it's going? You know, how can I find my way into it? Whatever it is I'm trading, even if I'm trading a range, how do I know where I sell it and where I buy it? Do I do both? And so timing is about that. Trend is about which way is it pointing. So let's talk about timing next. To think about timing, and let's just pull the charts back up and go over them. And I'll pull this chart up. To think about timing, one of the things I realized, and one of those aha moments was when I was writing the third book. I realized that there's really just two types of trades. There's either breakouts or there's retraces. Everything else is a derivative of those. And so if you think about a trade, and let's just take this trade, if this were to break out, right, the breakout would be a close over this high. And that would be a particular trade that one could trade. The other trade is, if it breaks out, is the retrace back to where it broke out. And so everything else that you do in terms of any type of trade you make is really either a breakout or a retrace, and traders tend to favor one or the other. The retrace gives you usually a lower risk point, and you get a little bit more information before you make the trade. The breakout assumes the momentum is going to continue. I personally am a retrace trader most of the time, and the reason for that is because most of the time you do not get breakouts that continue without a retrace, and a fairly soon retrace within 6 bars. So let me grab, I got an error here, let me grab the charts. And here's the chart. This is what I was wanting to show you. So if you think about trades in terms of a breakout, the vast majority of trades come back within 6 bars. And so that's what this graph is showing you, the number of bars to the first retest and regen situation. And we'll talk about retest, regen in a minute. But essentially, when you get a breakout, right, the high probability is that when that breakout occurs, and let's say this was the point of the breakout, the high probability is that it will come back and test that same area from which it broke out. And that breakout retest, this is the retest regen situation. We'll describe it in more detail in a minute. But the highest probability is that that will occur, and you can see this based on these various types of trades, right, the 4 types. a confirmed bullish, a suspect bullish, a confirmed bearish, and a suspect bearish. And so confirmed bullish, suspect bullish, you get probabilities of about 68 to 82 and about 67 to 80 on the bearish and suspect and confirmed bearish. Most of the time it's going to come back, folks. More than 2/3 of the time. And in some cases 92% of the time it will come back within 6 bars. So if that's true, most of the time you don't want to be chasing something that's breaking out. There are exceptions, and I'll talk about that. The one in particular is the multiple swing point time frame breakout. And let me just cover what that is while I'm here. And if I go here, let's say that it was to break this swing point high and that swing point high and close above it. Well, this swing point high is on November 2nd of 2015. And this one is April. Now, if I pull up a daily chart, right, you're going to find that that swing point high we just talked about, it would be a breakout of it as well. Actually, this one has already done it, so this wouldn't be a breakout. It would actually have to break over this swing point high now once it becomes a high. But the essential part of it is that you break simultaneously on the daily and the weekly. So within that same week, you get breakouts on the dailies and the weekly. That's multiple time frames. Or you get breakouts on the weekly and the monthly. Or you get breakouts on all three at the same time. When you do that, the probabilities of continuance are very high. And this is not what holds you back anymore. Matter of fact, you end up being that other 18% or 8% or whatever the number is, depending on what type of trade it is. And so that's the one case that tends to work in one's advantage. So that's the breakouts. Let me go back up here. And the breakouts and the retraces. So a breakout, I simply have a high, right? I get over it, I close over it. That's a breakout. Or I have a low, I get under it, close under it. That's a breakout. It's just a break, it just break out to the bearish side. The other case is I break out and now at some point I retrace to the high of the swing point high, which was broken, or the low of the swing point low that was broken. Those are the retraces, right? I come back to that point. So that's a retrace. So those are the two types of trades. Everything else is a derivative of them. And so you have to expect that that's what you're going to be interested in terms of your trades themselves. So when you have trend, and we've talked about trend, when you have that, you know which way you're going. Once you have a breakout, the retest regenerate zone is the early warning system that the trend, if it fails to regenerate in the direction of the break, that is an early warning system that is going to occur. So let's look at a chart and find a case like that. So here's a breakout, for example. Let's draw it in. This is the break off of this swing point high. Now, when it breaks, the retest regenerate zone is the area between the highs, the swing, because this is a swing point high, it's the high of the high and the low of the high. So when, in this case it's a very wide one, but when you come back and you test, you have to break this area, right, to get the early warning that this trend that was in effect is no longer in effect. And in this case it did break, and what you typically want to see is one more bar to confirm it. And in this case it didn't give you that extra bar. So technically this one actually breaks under the retest regenerate zone. So in other words, you go over it, you come back to try and regenerate higher, right? And in this case you came all the way down to here, and then it did hold, right? It got under it but didn't close under it. And then it tries to regenerate higher, but then it comes and tests it again. In this case it gets under it, doesn't stay with one bar, and again tries to regenerate higher, and in this case does regenerate higher. In other words, it gets back over that swing point high and it holds it for more than one bar. That's a retest regenerate zone. You use these zones. So anytime you see a breakout up or down, you use those zones to tell you how that's behaving when it comes back. That's where the market releases information. Why is it important? Because as it comes back, especially if the zone is small, when it comes back, you have, as a matter of fact, we actually have a more recent one here. It's over here, this swing point high. When it comes back, it tests into it. And if it can't get underneath it, right, it's telling you that it has a chance of continuing the trend. If it gets underneath it, even though it hasn't broken a swing point low yet, like for the trend to change here, it has to break this swing point low. It's an early warning system that it's going to try to do that. And that uptrend that was in effect is probably going to no longer be in effect. Matter of fact, the way I usually describe it is the trend that was this way is probably this way at best. When will it officially become sideways? When that swing point low is broken. Do you have to wait for that? No, you have an indication. If you get 2 bars, if you get under this low and you stay under it for a couple of bars, you have a pretty good indication, higher probability, that that's going to occur. So that's what you use retest regenerate zones for, to gather information about, is the trend changing or is it continuing? That's the whole point of the retest regenerate zone. Does it always work? No. Does it usually work? Yes. Probabilities are pretty high when it actually regenerates higher. How do you know when it's regenerating? It has to get back over the high. If we're doing a bullish one, it has to get back over it, right? In this case, has to get back over it for a couple bars. That gives you a pretty good indication it's going to try to continue for some period of time. Okay? When you put that together with like your mean time to failure, with any other things that we're going to talk about, right, you gather more and more statistical information to give you a better odds of which way this thing's going to trade next. Okay, so retraces, breakouts, trend, the bullish, bearish, retest, regenerate zones. Bearish, of course, is the exact opposite. It's just on the other side. And so, you know, if we take that same chart and look at it, we don't have a bearish one on this time frame. Let's go to the weekly. And here you actually do. So here was a swing point low that was broken right here. Broke right there. When it broke, it came down, comes back to test it, right? Where's the test? Well, the swing point low and its high of the low. That's the test. What does it do? It comes up and does a full retest. And what does it end up doing? Regenerating back in the direction of the trend. Gets under it, stays under it for a couple bars here and here, right? And once it does that, or actually it was these 2 bars, once it does that, now you know that more than likely this thing's going to try to continue lower. And in fact, that's what it does. When it goes down here, right, then you get a different set of tests that we'll talk about. In this case, a test failure, but we haven't got to that yet. So that's the retest regen. That's how it's useful. If you get over it, it's different. It's telling you it's trying to change trend. Okay, so continuing on here, let's look at the ideal of the support and resistance and anchor bars, and let's go over those concepts. So when you look at a chart, right? Again, we're using 60 bars to make it consistent, and we're using that for a couple reasons, not just to keep it consistent, but also to make it so that, and I'm going to go back to the IWM, make it so that you don't get an overload of information. When you look at a chart, this thing has other things beside swing point highs and swing point lows. It has the arrows, it's our trends, right? But it also has coloring. In particular, it has blue bars. Now, the blue bars are anchor bars. And why are they called anchor bars? Well, because they're significant. What you're always trying to do in a chart and when you're trading is find things that are significant. And those things are significant that you use, and in this case, any time we use the blue bar in creating these zones, it gets colored as blue. Now you can have anchor bars in this picture that aren't colored because they didn't get used. For example, this bar is an anchor bar, but it didn't get used. So let's talk about what anchor bars are. There's 3 types. There's wide price spread. This one's wide in price. In other words, if I take the average of all the bars on the chart and I get that, number, let's say it's 23 points, or in this case maybe 60 cents or something. 60 cents is the average. If I take this bar and I subtract it from 60 cents from it, if it's greater than 1.5% greater than 60, right? In this case it'd be 90 cents or more, then it's an anchor bar, a wide price spread anchor bar. And so I do that across every bar, and you can have a max of 6 of them. And so if it's greater than 1.5% of the average of the spread of all the bars on this chart, the 60 bars, then it's a wide price spread anchor bar. Same thing with volume. You take the top 6 volume bars, you see if it's 1.5 greater than the average of all the other bars, and if it is, then it's an anchor bar from a volume perspective. And finally, swing points are anchor bars. And so your swing points, so you have wide price spread, high volume, swing points. Those things can be combined in 2 different ways to create these zones that you see. If they overlap, so in this case, let's just take this one, the low of this bar, which is 106.80, and the low of this bar, it looks like it took, which is 107.99. The high of that same bar which we took its low, does it overlap with the low of this bar which we took? It does. And so this high and that low overlap, and so you end up with a zone, right? Because this bar has an overlap between those two. And so that becomes your zone. So it's overlapping or congruent. And the congruent one is just where they don't overlap. So there's like this, if there was a zone here, this bar and the bar that it used, let's say these 2 bars, April 12th and April 13th, that little zone there, if we were to use that, that would be congruent. It's small enough to be the 2 bars are close enough to make them valuable. In other words, they're not, the bar is not here and way up there somewhere. And it is, both bars are significant in that they both have either wide price spread or high volume or their anchor bar. And so we can create a zone from there. So you either have congruent or you have overlapping anchor zones. And they're not treated any different. It's just how you can combine things. And so what the programs do is they go through the chart every night on a daily time frame. They look at every potential zone that exists, and they dismiss those zones based on a ranking system that's kind of proprietary. Essentially looks to see, what was the value of the anchor bar itself. We rank the anchor bars as to how valuable they are. For example, this one's wide price spread and high volume, so it has a higher ranking than, say, just a swing point low that has neither of the other. And that ranking of the bars, when the bars are combined, you get a higher ranking for the zone itself. And it also has to do with how close it is to current price. And so given all of that, you get a ranking system. The highest ranked zones are the ones that get shown on the chart. And that's true of support and red, which would be resistance. And if we go to the weekly, we'll probably have a resistance zone somewhere, and you can see the zone there. Now, I don't really trade the zones as much. I really just look at the bars. What you're really focused on is what's significant. And so when I see a significant bar, like if I'm looking at this chart, that this swing point high is significant. This low that was broken, right, this breakdown bar, that area is going to be significant. So if I were to draw these out, for example, that little overlap right there is going to be significant on the way back up. And now you get into, are there other things? Well, that high, this high, that low, all are in the same price zone. It's just telling you that there was a lot of decision making made at that price point. And so when you come up here again, you can assume a lot of decision making is going to be made again. Because if I wanted to go short, that's the lowest risk place to go short. If I wanted to buy, if it breaks out, right, it's the lowest risk place to put on more exposure, to put on new exposure. So, these areas become significant, and if you can pick them out, when you come to test it, you can decide what it means. And so let's look at a test or two to understand that. So I'm going to go back to a daily chart because there will be more things on it that we can compare. Okay, so what just happened actually is significant here. This was a retest regenerate zone, the high and low of the swing point high that was broken on this bar, right? When it came back, it was more than 6 bars. Remember, we said that anything that comes back after more than 6 bars has a higher probability of continuance. In other words, it's going to bounce out of there. And so as it came back, it tested it, and the test is here. That low is 113.67. The low of the swing point high is 113.90. So you got under it, back over it. The volume here was 34. The volume there was 24. So you got under it, back over it, you had more volume. So that's a negative, right? It didn't fail, didn't stay under it, but it got under it, tested under it with more volume. That says it could come back and try it again. If it were to have lighter volume, it would be a nice clean test and give you more confidence that it's actually going to bounce back out of here and just keep going. The way this one is set up, though, having more volume, it says there's a higher probability that after it bounces some measure, it's going to come back and try to test it again. And so you can use that type of information to make decisions about, when you know things are significant, you can see the test take place, how it takes place in terms of how much volume it is, how price reacts when it gets to it, and make get more information to make better decisions about what probably will take place next. So we talked about anchor bars. We've talked about the zones now. We'll save the price projections, reversals, and magnets for the next show. And we've got some follow-up that's going to take place here in the next video where we continue on with this. Now, one of the things I went back and reviewed here is just before I finished this, was I reviewed the notes in terms of, did I miss anything? Why 60 bars? Well, because the chart gets too cluttered. You want to supply the same principles. The high volume anchor bars, the number of these are going to be too many if we don't standardize it on 60, because we're taking 1/10 at most. And it's just cleaner. Too much information is not good. You always look at 3 time frames, even though I'm not showing it here. When I do my show, I have all 3 time frames up. When I trade, I have all 3 time frames up. I want to be able to see that, if I'm looking on the daily chart trying to make a trade, I want to see that there's nothing on the weekly that's going to stop that trade, right? That's going to hinder it. It's going to interfere with it. And so you have all 3 time frames up, so that you can see if there's anything else out there that's going to hurt you or ruin the trade you're thinking about making. You do it on a daily, weekly, and monthly time frames. If you're doing an intraday, I usually use 35 and 15s, again, because they're about 60 bars to the chart. The longer term time frame is generally more important. You're going to have a lot less noise on a monthly chart, right? Because it doesn't change that much. It takes a long time to change when it changes. You're going to have a lot more information on that chart that is not going to be subject to immediate change than if you look at the daily chart, right? A lot more noise here than there is on the longer term time frames. And that will be true on any time frame. If I'm using 30 and 5 minutes, 30 is going to be a lot more or a lot less susceptible to noise. 6 is the key number, right? 6 to create your trends, 6 bars to create a swing point, 6 bars to actualize it, 6 bars for the retest regen. For whatever reason, 6 bars seems to be the harmonic number. Large directional moves that take place in short periods, they're valuable because the angle of ascent usually isn't sustainable. And so let's pull up a chart real quick and show you that. For example, here, and you'll see me talk about this a lot. Even though we got a nice big thing going and nothing's happened yet, as we're going up, that angle is an angle that can be sustained indefinitely is 45 degrees, which is about like that. When you're going like this, you know that's not sustainable. It's going to get some sort of a retrace back to the mean at some point. It doesn't always mean it's going to happen here. It could have gone up higher, but you're going to get it. It's going to happen. And so you have to be, the farther up this thing goes, the longer this trend exists and the steepness of it doesn't change, right? That's going to get a retrace at some point, so you keep looking for reversal signals, which we'll talk about in the next video, or the third video actually. Yeah, because a straight fast move without a pause increases the odds of failure at the next significant price area. So as you come up to things of significance and you've got a terribly strong angle, your odds of breaking and coming back, if you're going up, is higher. Test. We talked about test in the sense of a test failure. You can have different types of test failures. You can test fail against swing point lows and highs. You can test fail just against a high that doesn't happen to be a swing point high. It could just be a high volume high, right? And we may have one of those on this chart. Like this would have been a high volume high. Had this fallen back underneath it and closed under it, right? That would have been a failure on a high volume bar. That would have been significant. Would have said it's probably going to pull back more. So you can get test failures in different places. It doesn't have to be just swing point highs. It doesn't have to be just swing point lows or retest regenerate zones. It can be an anchor bar, again, a bar of significance. It could even be a range high-low test, right, where you have some sort of a range, and that range will be defined, and we'll define ranges in the next set of videos. But you'll probably have anchor bars as part of that range as well, and it probably will be an overlap of those two things. Anytime you test something, the next time you come back, it's gonna reduce your probabilities of that test actually succeeding. Or excuse me, it's going to increase the probabilities of that test failing, is a better way to say it. And so if I were to go down and look at this with respect to just a retest regenerate, the first time on the test, right, these are your probabilities. So depending on the type of trend, right, or actually how it fails, your cumulative probability of these white ones in the back. So the first time back, or excuse me, the second time back, your probability is around 60%. Third time back about 80%, and this is for it to fail. So the farther you come back, the cumulative probability is going to continue higher, and that's true of the number of bars. It's also true of the actual failure itself, right? The probability of that failure. We talked about trend quite a bit already. I don't think there's anything in here that I missed. You can read this in your notes. I think they're fairly self-explanatory. And I believe that's it for the first video. And we'll pick it up on the second video here in a bit. We'll continue out this one, some questions and feedback. And then the third video, we'll go over some more of these details and dive in a little bit deeper. Thanks. Take care.